Let us see the next question. The Easygoing Company Limited is considering a new project with an initial investment for a product called Survival. It is estimated that the internal rate of return of the project is 16%, having estimated useful life 5 years. The financial manager has studied that the project with highlight the portion sensitivity analysis and informed that annual fixed cost sensitivity is 7.8416 percentage, whereas for the discounting rate or the cost of capital the sensitivity is 60 percentage. Other information is given. Profit volume ratio is 70 percentage, that is contribution upon sales into 100. Variable cost per unit is 60 rupees. Annual cash flow is 57,500. Ignore depreciation on initial investment and impact of taxation. So whenever we have to ignore tax, we have to ignore depreciation, of course. There are certain questions provided to us. First question is compute the initial investment, compute NPV. Next is annual fixed cost, estimated annual sales units, break even. Cumulative discounting factors have been provided for 5 years from 8% to 18%. I do not want all answers together, but at least I want this answer. I request you to give answer of the first question in the chat box. Dear students, we know that IRR is the discounting rate at which NPV is 0. We already have been provided with the IRR rate. It is 16%. Cash flows are given to us 57,500. Rate of IRR is given to us as 3.7274. So please use your calculator. 3.274 into 57,500. So this is what we understand is the present value of the cash inflow, and that itself is the investment. Why? Because at IRR NPV is 0. I request all of you to write an answer for the first question. At IRR rate, NPV of the project is always 0. Full stop. We have been given IRR as 16%. Full stop. So initial investment can be found as under. I request all of you to write an answer. Column number 1 is year 1 to 5. Cash flows 57,500. IRR is 16%. At the rate IRR NPV 0. So 16% discounting factor is given to us 3.274. So 188,255. Amount of investment NPV 0. So the amount of investment will be found as balancing figure. I want you to tell me answer of the second question, that what is the NPV of the project, in the chat box. Now friends, in the second part of the question says that say compute NPV. Now dear students, for the purpose of NPV calculation, basically we require that what is the cost of capital of the company. I request all of you to write down answer along with me. Working note number 1, calculation of cost of capital of the company. That is the first thing that say we are required to do. Dear students, you can see that the question is providing the information that say for discounting rate or cost of capital, sensitivity is 60%. What does it mean? It means that say when the discounting rate increases by 60%, NPV goes down to 0. So we can say something like this: margin of safety in percentage term is equal to IRR minus cost of capital divided by cost of capital. So 0.6 is equal to 16 minus cost of capital divided by cost of capital. That's it. Please calculate answer. 0.6 into cost of capital is equal to 16 minus cost of capital. So cost of capital is transferred on the opposite side. So it is 1.6 cost of capital is equal to 16. Cost of capital is 16 divided by 1.6. That comes to 10%. Okay. So now we have got our cost of capital 10%. Now based on that, so the NPV calculation is very simple. Calculation of NPV of the project. In that, present value of cash inflow minus investment. It is annual cash flow into PVIFA at the rate of 10% for 5 years minus investment. 10% 5 years factor summation is 3.791. So it is 2,17,982.5 minus the amount of the investment is 1,88,255. So 217,982.5 minus 188,255. So 29,727.5. This is the way the NPV of the project can be found. I want you to answer the third question. What must be the annual fixed cost? Please write answer in the chat box. Now let us understand and say how to compute the fixed cost. Please write an answer. Annual fixed cost. Now basically what happens friends over here, something like this. Listen carefully. Regarding fixed cost, you can see that again there is an information provided to us. Annual fixed cost sensitivity is 7.8416%. What does it mean? If at all the fixed cost increases at this rate, NPV will become 0. So we understand something like this. Listen carefully. Increase in annual fixed cost into PVIFA at 10% for 5 years is equal to NPV of project. Now question is providing the information that there is fixed cost sensitivity of 7.8416%. So x into 0.078416. So this is the amount of the increase into 10% 5 years factor 3.791, and so this will wipe off the NPV. What is the amount of NPV? 29,727.5. So now X will be found as balancing figure. X is equal to 29,727.5 divided by product of this two, 3.791 into 0.078416. So please use your calculator. 29727.5 divided by 3.791 divided by 0.078416. That comes to 99,999.98. So near to 1 lakh. So existing fixed cost must be an amount of 1 lakh. That is what we understand. Please write down answer. Now the fourth question says that compute the annual sales units. I request you to give answer of the fourth question in the chat box. Now friends, over here, in order to compute the annual sales units, we have to use this information: variable cost and profit volume ratio. I request all of you to write down answer along with me. So answer of the fourth question: estimated annual sales units. In that case, write down answer. Working note number 1. Calculation of selling price per unit. That is the first working note that we will prepare. Friends, we know that the profit volume ratio is found as contribution per unit upon selling price per unit into 100. So profit volume ratio is given as 70%. Contribution per unit is selling price per unit minus variable cost per unit divided by selling price per unit once again. This 100 is transferred on the opposite side, so it will go in the division. So 0.7 into selling price per unit is equal to selling price per unit minus variable cost per unit is 60 rupees. Okay. 0.7 is transferred on the opposite side. So selling price per unit minus 0.70 selling price per unit is equal to 60. So 0.30 selling price per unit is equal to 60. Selling price per unit is 60 divided by 0.3. So I think it comes to rupees 200. So this is the way we compute the selling price. So that is 200. Next, calculation of sales units. Dear students, its answer is very simple. We understand that as far as a profit or cash flow in this example. In this example, both of them are same. Why? Because we do not have taxes. We do not have like the depreciation to be adjusted. So the profit or the cash flow is equal to contribution minus cash fixed cost. This is provided to us as 57,500. Contribution is contribution per unit into number of units minus cash fixed cost is 1 lakh. Now this is required to be found as balancing figure. So please use your calculator. 57,500 plus 1 lakh. As far as the selling price is concerned, it is 200 and the profit volume ratio is 30%. So 200 into, profit volume ratio is 70%. 0.70 into number of units. Now basically we require the answer in terms of number of units. It is 157,500 divided by 140. That is 1125 units. This is the way we compute that how many units are supposed to be sold on annual basis. What is the sales of the company on the annual basis? Please write down answer. Next, question number 5. In that the question says that you are required to make the calculation of break-even units. What do we understand with the term break-even units? It means simple as what we do. It is no profit, no loss situation. So please write an answer. It is break-even units. In that case, it is annual fixed cost divided by contribution per unit. The amount of the annual fixed cost is 1 lakh. Contribution per unit is 140. So we have break-even units as 714.28. That is 715 units. That is the way the break-even units can be found. Let us have summary of the entire answer. This is a kind of missing information question. Cash flows have been given to us. IRR is given to us. Life of the project is given to us. And the first question is, what is the amount of the investment? We know that said IRR NPV 0. So we have computed investment as balancing figure. The second question says that say compute the the NPV of the project. Importantly, NPV of the project is calculated by using the company's cost of capital as a discounting rate. So first of all, we make the computation of the company's cost of capital it is 10 percentage, because margin of safety is given as 60 percentage. Now we make the calculation of NPV of the project. In that, so that 10% is the discounting rate, and with that NPV is found. Importantly friends, margin of safety with respect to the cost of capital is indicating that if cost of capital increases at this rate, NPV will become 0. We already know that the IRR is 16 percentage. So accordingly we have made the calculation of answer. The third is the annual fixed cost. This is something which I think is important. I think that's here is the point wherein you need to be careful. Again, we have been provided with the margin of safety, that's the sensitivity, that what is the increase in the fixed cost that we can afford. The amount of the increase in the fixed cost is discounted in present value term. Present value of the same is going to wipe off the existing NPV. So accordingly, we are required to make the calculation of answer. Present value of the increase in the fixed cost is equal to NPV of the project. Accordingly, the equation is formed and we have computed, so the existing fixed cost as balancing figure 1 lakh rupee. Next is the estimated sales units. That is what's normally that very simple according to me. First of all, selling price per unit is found. Then sales units is equal to like cash fixed cost plus that is cash flow divided by so the contribution per unit, that is 1125. And the break even units is also very simple. It is the fixed cost upon contribution per unit. That is the way the answer is found. This is the way the answer is supposed to be found.